Hello everyone, welcome to Global Online. So today we are going to prepare for NTA UGC NET June 2024 cycle, that is Commerce and Management. In today's session we are revising our business economics unit with the help of the MCQs, and this is part 2. And who the student who haven't seen yet the part 1, the link has been provided in the description box. And after watching this video you can go through with the link. Okay, so the Dr. Swati's educator is here. So before starting our video, I will quickly tell you about our new batch. It will be started from the 20th of the May, and here you will get a complete course on commerce and management. The daily live lecture will be provided over here, and if you miss any lectures, so the recorded lecture is also available in the app. So complete syllabus notes in the PDF form is available. The full syllabus mock test is also available. More than 4,000 MCQ series with a detailed explanation, and the PYQs with a detailed explanation is going to be provided. Here you will get complete paper 1 is free of cost if you register yourself for the paper 2. And for registration for the paper 2, the Global Online provide you the 20% of the discount on the fees on in this amount, in the 8,000 amount. You can get paper 1 plus paper. You can prepare yourself, prepare with the paper 1 plus paper 2. The contact number, the WhatsApp only is given in your screen. So if you have any kind of query, you can get in touch with this contact number. So how to download the Global Online? Here you can see that the go to Google Play Store, and just search the Global Online and download the app and open it. Then register with your register number, and after that, after registration, you can go to the my course, and here you can search your course whatever you want. Okay, after that, after the registration is completed, you will get all the material of the recorded video lectures and the files and the PDF in the proper folder, so you can get your material in a very proper manner. Okay, so let's start with the first question which is in your screen, that is, according to dash economics is a queen of the social science. So here is the economics, the name is given in your option, that is Samuelson, Adam C, JB Say and JK Mehta. So these are the economists who give the different definitions. So first of all, this is a factual question, and you have to be very specific about this kind of question. So here you can see the of Samuelson. The right answer is a Samuelson. That is, Samuelson is give the queen of the social science. So what Samuelson is, economics in the is the queen of the social science. It is true. Economics is the queen of the social science when it is considered the brilliant man reveal the surprising truth about the nature of the societal interaction. So this question is a factual question again. So this is the right answer, the option number A, Samuelson give the, you can remember this like a social science in the queen, social science is queen is SS, Samuelson. Okay. Now the next question which is in your screen, the wealth-centered definition of the economic has been given by. Again, this is a factual question, and this is really important. The many times this is the kind of question, the definition, who give that. So this kind of question they ask in the paper, so you have to be aware of this kind of question. So the wealth, okay, the wealth centric definition of the economic has been given by, the wealth centric definition is given by the many economics. So the Walker also gave the definition, Adam Smith also gave the definition of the wealth, and the JB says also give the definition. So the option number D is right over here. Let's understand who gave the definition and when, and what the definition is about. Okay, now the wealth definition, the first definition is comes, the wealth definition is given is introduced in the year 1776. When? 1776 by the Adam Smith, who first give the definition of the definition of the wealth definition, who is give the Adam Smith give the definition. Okay, after that the welfare definition. Okay, after the welfare definition is come. So the welfare definition is given in the 1890 by the Alfred Marshall. Okay, then the scarcity definition is given in the year 1932. okay, is given by the Robin. Okay, after that, after scarcity, the growth definition is come. The growth definition is come in 1948 by the Samuelson. Okay, who gave the Samuelson? Then the modern definition which is currently exists is given by the AC Das. Okay, who gave AC Das? Now the what about the wealth? What the wealth definition is? What about what is about the wealth definition? What's about the welfare definition? What they said about this definition? So Adam Smith give this definition in 1776. Here he emphasized on the wealth. Okay, so wealth means that is a production activity. If you're increase your production activity, this production is so there is an abundant product is available in the market in the very low cost, so it will cover all the market area. So Adam Smith say that the wealth is maximization. How to wealth you maximize your wealth is to product due to production activity. When the Alfred Marshall came in 1819, focus on the production plus consumption. If you produce the Adam Smith give the only stress on the production, but Alfred Marshall said if you're only producing, then what happen if there is a scarcity of the consumption, there is no consumption there. If you produce a lot and if you consume a less, so what happen? This happen that there is an abundant of the unnecessary wastage of the resources. So this is an Alfred Marshall give the straight to the production plus consumption activity. Then Robin said that is highlight the problem of the scarcity. What the scarcity of the resources? You know, if you're producing many, if you consume unlimited, what happen? The natural resources are very scarce. The resources are very scarce. Like a petrol, now the petrol is very scarce. Okay, like other things, the water still is having the very scarce, less quantity remain. So what happen if you read if you're using these kind of things for more consumption, for more production, so it happen that a scarcity of resources. Then the Paul Samuelson said the focus on the production and the consumption activity achieving the growth. Okay, under the scarcity, you're utilizing your scarcity of resources, like that you can achieve your growth. Okay, the choice under the scarcity and the growth, so given by the Samuelson. Now the new, that is in 2011, the AC Das said the give emphasis on choice making in maximizing production and consumption benefit under what? Under the scarce and the surplus and achieve the growth. Okay, what? Achieve the growth. Here here achieving the growth and the choice under the scarcity, surplus and the growth. In the Samuelson give the stress only to the scarcity and the growth, but there are the many things is also having the surplus in our also utilize that surplus and make a growth of your area. Okay, so is given by the Das. Okay, so the answer is, the correct answer is option number D. Clear it? Now, domestic income is which concept? Now, the domestic income, the option number A, national, B, economic, C, territorial, and none of the above. So, first of all, what is a domestic income? You know that domestic income is related to our GDP. Okay, that is a gross domestic product. Okay, gross domestic product. So what is it, the gross domestic product? GDP is the sum of, it is a sum of what? Sum of market cost. At the rate market cost is the sum of market cost of a final product, whatever the final product produced in a particular year, in a fixed economic territory. In fixed economic territory is there, in the boundaries of the economic territory, that is a GDP. So what is domestic income, in which this concept domestic income means which the product is produced within the boundaries of the economic territory, fixed economic territory. Okay, so that is that is domestic income. So the option number C, that is domestic income, is a territorial concept. Okay, it's not a national, it's not a economic, because we calculate a domestic income on the basis of our boundaries of the territory. Okay, now the domestic income territory concept, because it based on the income generation within the geographical territory, whatever the geographical territory we have. This is India's. Okay, so this is the boundary of the, okay, the boundary of the is whatever the produce in the boundaries of the geographical territory, that is a domestic income. Now what if NFIA is negative? What does mean of the NFIA? What is the full form of the NFIA? First of all, NFIA, income from abroad. Okay, NFIA, that means net. What does mean? It is a net factor income. It is a net factor income from abroad. Okay, so when our net factor income is negative, so let's understand the, first of all, let's understand the what is a net factor income. Before understanding the net factor income, for calculating the national income, we need NNP. What we need? NNP, net national income, net national production. What is it? Net national product. Okay, and for calculating this net national product, we need a GDP. We set our GDP, you know, every you have heard about the GDP. So in the budget, when they our GDP growth rate increase in this rate, so this is a GDP. So what is GDP? GDP means a domestic gross domestic product. So what is the difference between these two terms? So let's understand GDP and NNP. When we, this is a gross and this is a net. Okay, so when we move from the gross to net, there is some operating expenses is there. So what kind of operating expenses? In the economic term, we have the many operating expenses, but here we deduct our depreciation. Okay, after that we move from the domestic to national level. We are moving from the domestic to national level. Here we add the NF, net factor income from the abroad. Okay, now what is a net factor income from the abroad? And the GDP is always calculate on the market cost, and the NNP always calculate is on the factor cost. Okay, so let's understand from the from the market cost. When we are going to the factor cost, in that case we here we uh here we add, here we less the our indirect taxes and add subsidies. Okay, add subsidy. Now let's understand this is, what is it? What is a net factor income from abroad? There is in two countries. Suppose this is a USA and this is India. Okay, so here in India, there is an Indian company. Okay, there is an Indian company who earn the 100 rupees. Okay, and there is another company, that is a Japanese company, who suppose 50 crore. Okay, here is 100 crore. He is this Indian company. Okay, this is Indian company. This is a Japanese company, Japan company. Okay, and here is Another one will I take, that is the China. Okay, so here China on 19. Okay, suppose 90 crore. So is it China? Or now here is a USA. So USA's company earn here 400. Okay, 100 crores, and Indian company earn in the USA, that is 100. So what is it? What is it? Is it about, this is the 100 rupees. This is the 100 rupees. It is the income from the abroad. Okay, this is income from the abroad, and this is 50 and 90. This income is income to the abroad. Okay, that means the India earn from the abroad 100 rupees, and India give 140 rupees to the abroad. So what is a net factor means, from when we deduct, when we calculate it from the domestic, whatever the domestic income we have from the domestic production, we add income from the abroad. With income from the abroad we are added, and income to the abroad we deduct. So this is the difference of the income, net income factor. Okay, that is a net factor income from the abroad. So what is happening over here, that the terms statement is given, the factor income to abroad will less when it will be negative. The question is about whenever our NFI, net factor income from the abroad, is negative. When it will be negative, when it will be negative, if income from the abroad is less than the income to the abroad. Okay, then it will be negative. That means our India is earning from the abroad, it is less from the India. But if the USA earn more in our India, so it will be negative. Okay, and when it will be positive, when India earn maximum from the abroad as compared to the USA. So when it will be negative, it will be negative. The first statement is given, income, the factor income to abroad. To abroad means USA. USA is less than, we write over here, that is, here is a USA and here is India. Okay, if the income to means USA, okay, to abroad is less than the factor income abroad, so it is what, it is less. Okay, sorry, I read if the USA income is less than the from the abroad, from means income. Okay, so what happened, this is it will be negative or positive, ma'am? It is a positive. In that case the NEFA is positive. Now the next statement, the factor income to abroad, factor income to abroad means USA. Okay, equals to, it will be equals to factor income from the abroad, that means India. So it will be negative. No, ma'am. The factor income to the abroad is more. To the abroad means USA is more than the factor income from the abroad, that means India. So in that case, it will be negative. So the option number C is right answer over here. Okay, hope so you understand this concept. Now, option number C is right answer. Now, which of the following is a component of the expenditure method of the income, national income? Let's understand. First of all, the national income. The national income expenditure is calculated on the basis of the expenditure method. Okay. So what we need the consumption expenditure, whatever the consumption, the private final consumption expenditure, plus here we've added the government final consumption expenditure, what the government is expenditure for consumption. Okay, spending for the consumption. Next we added the gross domestic capital formation. Okay, and from this we will deduct the net export, and these are the terms we use in the, what we use the private final consumption expenditure for in the expenditure. Here we using the expenditure thing, that is a private private final expenditure, government final expenditure, plus domestic capital formation, what we need for the domestic capital formation, and then we deduct the net export. Net export, what is a net export? From the export we will when we deduct our import, so that is a net export. And what is a gross domestic capital formation? Gross and fixed capital formation. In the gross fixed capital formation, we add the inventory, whatever inventory is invested. Okay, that is the gross domestic capital formation. Now understand how to calculate the expenditure method, how to calculate the national income from the expenditure method. So we add all the things, that is a private final consumption expenditure, government final expenditure, we had seen it over here, then the government the gross domestic capital formation, and then we add the net export. So after that we will get a gross domestic product at market cost. Okay, gross domestic, that is GDP at the market price. Okay, and after there we getting that, we'll convert it to the NDP, net domestic product. So for converting to the net domestic product and to gross domestic product to net domestic product, we deduct the depreciation. And for converting the market price to factor price, so what we do? We deduct the net indirect taxes. And what is the net indirect taxes? Nothing but indirect taxes. From the indirect taxes we deduct, government gives some subsidies to us, so we deduct here some subsidies. Okay, subsidies. Clear? So here we add the here we deduct the indirect taxes and we add the subsidy. That's why we reduce the net direct taxes. Okay, so now after deducting this, we will get a domestic income, that is NDP at factor cost, and from these factor costs we deduct our NFA, the net factor income from the abroad. We add it on this, and after that we will get national income. Okay, so what is it? What is about our question? The question is about which of the following component of the expenditure method is a national income. So here you will see the private final consumption expenditure. Yes, over there. Net export. Yes, ma'am. Gross domestic capital formation. Yes, ma'am. So all of the above is right answer for this question. Clear it? So all of the above. Now the explanation is also given in your slides. Now next question, which is in your screen, the output at the current year price is called as. There are the GDP is divided in two things, that is a real GDP and the national GDP. Now how do we calculate the real GDP? Is based on what? How do we calculate the national GDP is based on what? So let's understand. So look here, the nominal, sorry, it's not national, it's a nominal. Huh? It is a nominal. It is a nominal GDP. Okay, so let's understand what is a nominal GDP and what is a real GDP. The nominal and the real GDP refers to the market value of the goods and services produced in a country at a current and the constant price. Okay, there are the two GDP we have to calculate in the market value of the goods and services. For the goods and services, whatever the goods and services produced in the country, and it is on the current price and it is on the constant price. So now see, the nominal GDP refers to a GDP at current price. Always nominal GDP is calculated on the current price, whatever the current price we have right now, so that in that current price the GDP is calculated. So that is a nominal GDP. In the other hand, it is the market value of the goods and services produced in the domestic territory of the country in the year at a current price. Okay, what is the real GDP? Real GDP at a constant price. Real GDP we calculate on the constant price. In the other hand, GDP is the market value of the goods and services produced in a domestic territory of the country in the year at a base year. And here you will see in the nominal it is a current year. Clear? So what will be the right answer for this question? Option number C. This is a nominal. The question, something is wrong. That is A option is not here, that is a nominal. Okay, nominal GDP. Clear? So option number A is right over here. Now, next question, that is there is an two list, the matching is given, pair of matching. So let's match this. The option, the column number A is about the money supply, okay, national income, investment, taxes. So how it is related to the column B, injection, stock, leakage and flow. First of all, you have to understand the concept, that is what is a money supply. Money supply is a stock. What is it is a stock variable, because it is expressed at a particular point of time. That is, money is supplying in a stock. So stock, it is stock variable because it's supplying in the particular time of particular point of time. So the money is matched with the stock. So where is the money supply? That is A. And where is stock? Here is, that is A having a 2. Next, national income. National income is a flow of concept, because in the national income we measure our over a period of the time. Okay, we measure the national income over a period of time. So it is a flowing concept. It's not a static concept, it is a flowing concept. So that's why the national income is a B over here, and it is what is connected, is related to the flow of. So it, here is option is a 4 for the B, option number 4. Now, what is injection? Injection means you're investing in the government, you're investing your income. That means you're injecting your income, or you're investing in something that is like an investment in government spending, in the export. So this is a injection. So investment is related to, that means C is related to 1. Then the tax. The tax, that is leakage. Leakage means leaking something. That means you are paying taxes every year. So the occur when the withdraw of the money from the economy, that result in reduction in the national income, and source of leakage, that is the source of leakage like taxation, saving, import. Import is a leakage and injection is a export. Yes. So option number D having 3. Okay, so where you get this option 2, 2, 4, 1, 3. Okay, so option number C is right over here. Clear? Now the firm will shut down in the short run. There in the short run, when the firm is going to be shut down in short term. The option number 1, fixed cost exceed revenue, total cost exceed revenue, it is suffer from the losses, and the variable cost exceed revenue. Here you can see, we will write that is fixed cost, net fixed cost is exceeding the revenue. Okay, total cost is exceeding the revenue. Sorry, again we'll exceeding. Okay, then if suffer from the losses, and the variable cost is exceeding the revenue. So you know that the revenue, if your revenue is not earning revenue, then whatever the cost we are spending, that is going to be in the loss. Okay, so here you can see these your suffering losses is also having the same, but here you have to choose for the short run. Okay, so for the short run, here you can see the short term is affected, is morely affected by the variable cost. Okay, by the variable cost. Let's understand. Here, you know, here you can see in this diagram that this is the marginal cost. Marginal cost intersecting to the average variable cost. Okay, this is a variable cost line. This is a total cost. Total cost is what? Variable cost plus fixed cost. Okay. So here you can see this the marginal cost cut to the variable cost at this point. Okay, again it goes up, and the is cut to the total cost at this point. Okay, when the marginal cost cut to the total cost. Okay, so in that, when they are equilibrium, they are at a, say they're cutting, when they are at a equilibrium, this point is known as a break even point. Okay, there is a break even point. And if the marginal cost intersect the variable cost, okay, at the point, and this point, here you can see the cost and the variable cost, the marginal cost and the variable cost intersected when the average is at minimum. That means average variable cost is at a minimum, the marginal cost is continuously increasing. Okay, so in that point, the marginal cost is continuously increasing, but the variable cost in his is also increasing, but marginal cost is increasing very steadily. Okay, so what happened? This is the shutdown point. Here company need to shut down, so this area is a shutdown point. This is the minimum loss area, and this is a profit area. Okay, so this is a profit area, this is a loss area, and this is a where the company need to shut down their industry. Okay, so what is about when the price, let's understand the if the price is greater than the total cost. When the price, that means cost. Okay, whatever the cost is spended in the industry, so whatever the cost, if the cost, the price is greater than the average total cost, the firm make a profit. Still the firm make a profit. Okay, and if the total average total cost is greater than the price, and price is greater than the average variable cost, there you can see here, that is, here is average cost is upper side of the average variable cost. So here the average cost is greater than the price. Here is a price, and the price is greater than the variable cost. So here is a this area is a loss, minimum loss area. Okay, now when it is a shutdown point, when our average, this line is average variable cost is greater than this selling price, whatever the in which amount we are selling the product in the market, if it is greater than the selling price, so it is in that point company going to be temporary shut. For the short term, this will happen. So here you can see the short run shutdown point is directly related to variable cost. So if the our variable cost is greater than the revenue, so the company going to shut in the short run. So option number D is right answer over here. One more thing, that is if what about the in the long run? This is this all is about the where when the company is in it is short run. So what about the long run, ma'am? In the long run, if a price is greater than the the total cost, okay, the long run is related to the total cost. Okay, average, you can see average total cost. Okay, so if the total average total cost is less than the price, okay, so the firm make a profit. But if the price is less than the average total cost, in that case, in the long run, company going to be shut down. Okay, so just keep in mind, for the short run, the variable cost need to be less. Okay, for the short run, and for the long run the total cost is need to be less. If these two things are going to be high than the price, then company goes shut. Okay, next question, this is right answer. Now the next question, the cost that depend on the output in the short run, the cost on which the in the short run. So here for the short run, okay, is talking about the cost is depend on the output in the short run. The option, the statement number 1 is given that both the total and variable cost. Okay, then the total cost only, total fixed cost only, and total variable cost. You have to just I will tell you that the in this I think in the previous video in the part 1 I've already discussed this point. In the short run, the cost is variable cost plus fixed cost. Okay, short run is depend on the variable cost plus fixed cost, but in the long run the cost is only having the variable cost, because they are vary from the time to time, because it's running from the long lasting, they're endless. Okay, so that's why the things that the cost will be going to be vary from the time to time according to the situation. Okay, so that's why for the short run, the both A, that is variable cost, and the total cost. So the option number A, the cost is depend on the output short run for the total cost and the variable cost. The next set is economic resources. So economic resources is unlimited. Yes, economic resources is unlimited. No. The B option, the limited in supply and use. C option, limited in supply but has a alternative use, and the option number D, unproductive. Yes, economic resources are limited to supply but having their alternative use. Okay, so this is the actually this is the definition. Okay, this is given by the Marshall. Okay, now the next question which is in your screen: for the rational consumer who has choose between the two goods in the context of the budget strain, the price changes of one of the goods, that is a ceteris paribus. Okay, that is a ceteris paribus will be determined. Here, let's understand what is the term ceteris paribus. Ceteris paribus means all other things being equal. All other things being equal. Okay, now let's understand, if the rational consumer is there, okay, who has a choose between the two goods. Okay, a goods, that means a tea, suppose, and here is the coffee. Okay, here is the coffee in the context of the budget strain. If it A is a person who is getting their budget for the, and now there is the and he has a two option, that either he consumed the tea, either he consumed the coffee. So what happened here? The price changes of the one, if the price changes of the tea, if the price of the tea is going to be increased, what happened on the goods? So what happened to the coffee? What happened to the coffee? If the tea is increases, the what x the person is, if the price of the tea increases, the a person shifted to the coffee, because coffee's demand is going to be increases. Okay, so here is a price is increased, demand of the other goods going to be increased. So these are the substitute goods of the each other. Okay, so the tea and coffee are the substitute. So the question is also about what. Now let's understand the question by the diagram. Parallel shift of the budget line to left. If a substitute diagram is a convex to the origin. Clear it. Now it is a convex to the origin. Here you can see this. Here you can see the parallel shift to the budget line. If I shift to the left, okay, that means in the here is a left. Okay, so this is a IC curve. Okay, and this is IC1, IC2. So what happened? What happened is shifted to the, if you here is a normal. Okay, and here if you are change the price, here is a normal price. Okay, if you change the price to P1, the quantity is also going to decrease, okay, of that product, but the quantity of the other is going to be increased. So is it right? No ma'am. What happened if it the price is decreasing, the quantity also go, the other product, the substitute goods quantity is going to be increases. If the change, the next option, a change in slope of the budget line. Yes, the change in the slope of the budget line, or option number C, no change in budget line. Yeah, because yes, it will be change in the budget line. So option number C is wrong. A parallel shift of budget line to the right, it is shift to the right. No ma'am, it will not shift to the right. It's only C, only here you will get the changes. There is no actually the data is whatever the in the question, there is not specifically given what is happening over there. So we not conclude that is only about the price changing. Okay, so the change in the slope of the budget line. Okay, so the option number B is right over here. Okay, so option number B is right. Clear? So thank you so much for being with us. Let's continue with us, and we'll see you in the next video.